Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. Today's show is all about alternative investments. It's pretty frequent that we have people come into our financial planning office with a lot of interest in alternatives. Maybe that's private equity or venture capital or some kind of real estate or commodities offering. By and large, alternatives can be a great option and a great addition to your portfolio if and only if you've checked a few boxes first. In today's episode, I want to go over what alternatives are, why they exist, why they can be a good addition, and a few things to look out for if you're indeed considering one yourself. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today's podcast episode is on alternative investments. I hope if I'm successful in today's episode, we're going to cover everything that you need to know about alternative investments, including what they are, how you might participate in one, whether it's a good idea, what's an example of a good alternative investment, what's an example of a not so good alternative investment. And with any luck, you'll have what you need to make a reasonable decision about whether this might be something to explore further or not. Now, an alternative investment in general is any kind of investment opportunity that doesn't fit your basic categories of stocks, bonds, or cash. And some alternative investments, so if we're building a portfolio and trying to start by evaluating the right asset allocation, some people will want to put alternative investments in and count that as part of their equity. So, for example, if you're someone who owns real estate investment trusts, that are investments that hold a whole bunch of different real estate properties, you might consider that part of your the equity portion of your portfolio. Some people like to split that off and include four main categories in their high-level asset allocation, which would be stocks, bonds, cash, and alternatives. So alternatives are anything essentially that don't fit those other three categories. They're not cash, they're not debt instruments, they're not stocks. Real estate is the most common here. The other types are typically private equity, hedge funds, venture capital, commodities, real estate, anything that doesn't fit those main categories. Now, it is possible to find alternative investments that fit that definition in the public markets. So there are mutual fund managers out there that run alternative investment strategies. It's pretty easy to buy a publicly traded real estate investment trust these days. There are index funds that track the REIT or one of the REIT indices. You can buy them for very little cost. They retain total liquidity. They're still required to distribute a certain amount of their income every year back to shareholders. It is possible to buy alternative investments through the public markets. What I'm going to focus on today are the alternative investments that do not trade publicly. So these are the more opaque, the murkier options. A private equity fund is probably never going to trade over the public exchanges. A real estate fund could. The reason for that is a private equity fund is a manager that's pooling investor dollars together, and they're buying one or more smaller businesses that are not publicly traded. That's why it's called private equity instead of public equity. And they're maybe introducing management to new potential customers. They're providing consulting expertise, and they have some thesis and strategy for improving the performance and profitability of these smaller businesses. And then at some point in the future, they're expecting to return some of that newfound profitability to shareholders or perhaps sell the business at a gain. So if you're running a strategy like that, it doesn't make a whole lot of sense to do that through a mutual fund where you're required to entertain redemption requests from investors, right? A mutual fund, an ETF, those are all just different vehicles that investment managers can use for distribution, right? You can also have a private fund that only allows redemptions in certain windows, and that makes a lot more sense, frankly, for private equity and venture capital, right? If you and I got together and we went around and solicited all our neighbors in the neighborhood for $100 each to start an S&P 500 fund, then that might make sense to do through a mutual fund or an ETF, because some people inevitably are going to want to sell the investment. They're going if this is a mutual fund, we're taking dollars from our investors, we're putting them into an account, and then we're buying each of the 500 S&P 500 companies. And we can do that on the public exchanges. It's very easy. And so when one of those investors wants their money back, well, guess what? We have to sell a little bit of the underlying stocks to raise the cash to give back to the investors. That's how it works. So mutual funds and ETFs make sense for index funds. They make sense for investments in public markets. They don't make a whole lot of sense for most alternative strategies because, again, I use the private equity example. You don't want to have to entertain redemption requests at any point in time. These are probably longer term investments, longer term plays. And at the same time, another example would be a real estate development deal. I've seen all sorts of alternative offerings where there's a real estate developer and their place in the value chain is that they go buy land that's not zoned, that's not ready for development whatsoever. They take investor dollars together, they go buy these parcels of land, and then they go through the local, whatever the local regulatory process is to get them zoned. They get them ready for hooking up to the water and the electrical and the sewage grid and all that stuff. And then they sell them in that state, ready to be built on to another party that comes and builds houses or apartment buildings or whatever. That's their strategy. But it takes several years to go through that. And so if you're managing that strategy, it doesn't make a whole lot of sense to entertain redemptions whenever your investors want. You have to wait out this period, which is usually 3, 4, 5 years or longer. And there are great investments out there that simply just have a longer time horizon. But if you're in a position where that matches your needs, you don't need any liquidity and you can take the risk, then potentially you can get great returns from it. So that's generally what we're talking about here. The other strategies I mentioned, hedge funds. Um, the classic example of that is a long short hedge fund where a manager is taking money from their investors. They're trying to identify what stocks are overvalued and undervalued. The ones that are undervalued, they're buying. The ones that are overvalued, they're shorting. And the selling point is that they're supposed to be insulated from macro moves. If half your portfolio is short and half your portfolio is long, then a 5% drop in the S&P isn't going to make a whole like a difference because theoretically you're market neutral in that sense. So you can find those strategies in mutual funds and ETFs. You can find some real estate strategies in mutual funds and ETFs. But today I do want to focus on the stuff that's not publicly traded. So one of the benefits from the manager's perspective, if you're going to develop land, using the example that I gave, or if you're going to go run a private equity fund, go buy smaller businesses, turn them around, make them more profitable, sell them at a higher multiple later on, those strategies require longer runways. And so your typical investment vehicles, like the mutual fund and the ETF, don't make sense because your time horizon does not match the liquidity and redemption requirements of those kinds of investments. The other benefit of offering this in a private offering as opposed to a public offering is that you simply don't have as much scrutiny from the SEC. Private equity funds are governed by they're covered by the Dodd-Frank and Wall Street Reform Act, is my understanding, but they don't necessarily have to register with the SEC. If you're a mutual fund manager, you have to register with the SEC on top of offering liquidity daily. And there's a whole bunch of regulatory and compliance work and headache and costs that comes along with that. So this structure for alternative investments really does make a lot more sense. Now, the government, knowing that private investment managers have less oversight through this channel, they don't need to entertain redemption requests. Historically, they have limited private investments to accredited investors only. And so what that means is that the investment manager running the fund has to confirm that everybody who's buying into their fund is what's called an accredited investor. What that means is that, not including the equity in your house, you have a net worth of $1 million or more, or if you're a single person, you make more than 200 grand a year. If you're married, you make more than 300 grand a year. If you check one of those boxes, then you're considered an accredited investor, and in the government's eyes, have the financial capacity to take the risks and deal with the liquidity restrictions in one of these offerings. If you're not an accredited investor, historically, this simply wasn't available to you. You had to buy, if you're interested in alternative strategies, you had to buy through the public markets, through a public real estate investment trust, or an ETF or mutual fund. Maybe a unit investment trust is another form that's been out there. Now, this may have changed in the last couple of years. I have heard that this has been relaxed. I don't deal with alternative investments directly like every single day. It comes up relatively frequently throughout the year, but it's not something that I know every specific nuance on. So if there's somebody out there that knows definitively whether you can buy into alternative issues without being an accredited investor these days, that would be interesting. And it's probably a Google search away. I just haven't done it yet. Okay, so let's go through some examples of alternative investments that I would consider good, and then I'm going to contrast those with alternative investment offerings that are not so good. I think, well, let me back up. We talked about different categories: real estate, private equity, hedge funds, venture capital. Real estate, self-explanatory. I gave the land development example. This could really be anything. It could be someone that goes in and buys up apartment buildings and then rehabs them and sells them. It could be somebody that builds new apartment buildings or new hospitals and then sells. It could be anything that fits that real estate category broadly. Private equity typically has to do with buying or financing smaller businesses, smaller than your publicly traded corporations, that have that already have an established base. You're not typically referring to investing in new startups. If you're deploying capital and investor money into new startups and helping them accelerate their growth, coaching the entrepreneurs, maybe, that's venture capital. And what the venture capital firm is going to be doing is a little bit more hands-on management. And typically in the venture capital world, the aim is to take somebody from $1 million of revenue to $500 million of revenue. It's not to come in and reduce costs and double or triple profitability. You're looking for like a 100x on your investment. Hedge funds are typically alternative strategies in public markets. So that's a little bit different, right? We're talking about investing in companies. A private equity fund is a more traditional investment in a private company that is not accessible to ordinary investors over the public markets. Venture capital is typically a cash injection to a new company that's growth and and maybe tech and innovation focused, that has a lot more long-term potential. Hedge funds are typically using the public markets in a new way to extract returns, and the industry speak here is alpha. If we're going to invest in an S&P 500 fund, we're not trying to draw alpha. We're just taking what the market is giving us. A hedge fund who's taking the 500 S&P 500 companies, picking the winners and avoiding the dogs, is trying to extract alpha. And so if they pick the 300 companies that they think are going to perform best and omit the other 200, if the S&P 500 returns 10% that year, but their fund does 15%, that extra 5% is what's considered alpha. After having been in this game for a while, consistent alpha in the public markets it's very close to impossible. It is very hard. There are, I think, hedge funds out there that consistently do produce really good returns, but they are not restricting their investments just to the public markets. And another way of putting that is, if you and I got a bunch of money together, and I considered doing this at one point in my career because I thought I was pretty good at it, and I still think I am pretty good at it, but it's so risky and volatile that it just doesn't make sense to start a new hedge fund. But if you and I were to get a bunch of money together and start a hedge fund where we buy companies we think are going to do great and we short companies that we think are not, I am not confident in its success. There are so many people out there that are doing that using the exact same publicly available information that we would have. It's more luck than it is skill to produce those consistent returns these days. Now, that being said, the other types of alternatives, so those are hedge funds, the other types of alternative investments like private equity, private credit, which I'll get to in a moment, that has a lot of merit. Because when you get into private equity, now you're accessing a new section of the market that the vast majority of investors around the country and around the world simply don't have access to because they're not accredited. And because private equity funds don't trade on public exchanges every single day, like we talked about. So if you're at a point where you can take a fair amount of investment risk, you have the cash to lay out for a number of years, probably at least 5 to 8 in most circumstances, and there's absolutely you're very confident you're not going to have use for this cash over that time horizon, then this might be a good option because you're investing in an asset class, these smaller businesses with management help of the fund managers that are not available to most investors. And so we've talked, quite a bit on the show over the last couple of years about how asset prices have been bid up throughout this policy of easy money that we've been under for the last decade. When interest rates are low, money's coming out of the banking system, it's flowing very freely, and people are using that in general to buy up all the risk assets. So your PE ratios on public stocks are really, they're still in the they've come down after last year, but they're still in the higher range historically. If you have $1,000 to invest and you can choose a publicly traded company with a PE of 35 or a private company with the PE of, I don't know, 15, you tell me. It may make more sense to access this new market because it's been restricted from other public investors and potentially hasn't been bid up as much. So it's just a slightly different asset class. It's one that the general investing public can't get into, and because it's hasn't been exposed or bid up for those reasons quite as much, there are legitimate opportunities in that space. Now, I mentioned private credit. Just like equity, private credit is the debt of smaller companies that's not publicly traded on the exchanges or in the secondary bond market. Private credit, I have heard, is a really good opportunity these days. Now, when you're buying into a private credit fund, it's similar to buying any other bond fund. Your fund manager is going to take your cash and buy loans to a bunch of different smaller companies. Those loans might pay interest, but they'll mature at some point in the future as well. And so what you're getting here, because these companies have directly decided not to access the public bond markets, they've gone to private fund managers, which is a little bit less costly compliance-wise for them. If you don't need to raise as much money, that can make more sense because it's a little less costly than going through the public markets. But if you're a smaller company that's accessing these channels in the first place, there's a little bit more risk to investors. And so bond managers require a higher rate of return, a rate of interest on these private notes than through the public markets. So if you're in the position where you can take this risk, there's slightly higher credit risk. Again, the companies are smaller. They're probably more likely to go bankrupt in an economic downturn than your S&P 500 companies, but you can definitely command a higher interest rate, or you should command a higher interest rate by going that route. So again, for people who are in the position, you've already got your emergency fund topped off. And we went through the financial order of operations for business owners here a month or two ago. To refresh everybody's memory, you've got your emergency fund topped off. You have ample working capital in your business to fund operations if things go south. You have a company retirement plan. You're maxing out your contributions to a company retirement plan. You've got all your high interest rate, all your non-mortgage debts paid off, I should say. That includes credit cards, auto loans, everything else except your mortgage. And you're putting money into maybe an education account for the kids if that fits your needs. If you've got all those boxes checked, then this could potentially be a good idea for you, because the long-term returns are going to be good because there's a liquidity and a risk premium on this. So if you're comfortable locking up cash for a few years, at least 3 to 5, often longer than that, and you're comfortable with the risk that's involved, you're comfortable with the management and their strategy and their history and their track record and the group and their story, if you're comfortable with all that, then this could be a pretty good addition to your portfolio and a way to build a diversification and boost your long-term expected returns. So in general, I endorse this if the boxes have been checked. 9 times out of 10, when people come in and they want to get into this stuff, they don't have those boxes checked. They want to buy alternative investments, but then they have like a $50,000 auto loan. And I say that's silly. Let's look elsewhere. Maybe pay off that auto loan first. Maybe they have the alternative, but they haven't begun a core portfolio yet. They have a 401k at work, but they want to use that to go buy apartment buildings and other stuff. And I say that, look, keep the core portfolio in your company retirement plan after you have those first 9 boxes checked that I just covered, and all your short-term debts are paid off. Then we can circle back to the alternatives, because there are legitimately good options out there. Now, here are a few bad examples that I've seen of alternative investments, or more traditional investments in the private markets. And by the way, I don't want to confuse what we're talking about today with Reg D offerings either. A Reg D offering is a way for a company to raise money through the private markets without having to go public. And so if you think of like Facebook, for example, didn't go public deliberately for a decade or more. They could have gone public very early and raised a lot of money, but doing that presents a lot of SEC scrutiny, a lot of compliance costs and headaches. You have to forecast and report your earnings every single quarter. When Facebook was looking longer term than that, they didn't want all that scrutiny, so they raised money from the private markets instead. That's a Reg D offering. A company wants to raise money for growth, but they don't want to do that through the public markets. Well, you can avoid all the SEC scrutiny and raise money through that mechanism. This is not what we're talking about today. We're talking about a private investment fund in an alternative asset class, which is just slightly different. So here are some bad examples of alternative investments that I've seen. One of them is a very traditional, very ordinary investment in public markets that's traded through an illiquid and private vehicle. If you are going to invest in an index fund, that is a great strategy. I am all for it. Investing in the S&P 500, just buying everything without scrutiny, I think is a great strategy. Warren Buffett has been a huge proponent of that. If you're going to go that route, you should have liquidity whenever you want, because it is so incredibly inexpensive to buy that group of stocks for almost free and pay maybe 0.04% per year to the manager through an expense ratio in a Vanguard fund. It's as close to free as we can possibly get these days. I have seen a number of people get sold what are called unit investment trusts, where there's a manager of a private investment go around the neighborhood, solicit investor money, and then use the cash to buy the S&P 500 stocks. And that is nonsense, because when you go through that mechanism, the financial representative selling the unit investment trust gets a commission from it, which comes out of your pocket. It's more expensive in terms of ongoing expense ratios, and you often can't get out of it. There is no reason that the manager has to entertain redemption requests on an investment structured like this. So a bad example, and I've seen this numerous times, by the way. Somebody thinks they're buying the S&P 500, but it's just through this funky structure that a financial salesperson stuck them into, and now they're struggling to get out of it, and they don't know what to do. It's brutal, but it happens. So if you're buying a traditional investment in that manner, don't do it through a private vehicle. There's absolutely no need for it. On top of that, if you're going to entertain this kind of investment option, make sure it's legitimate. You want to do some due diligence here on the strategy, on the team, on their background, on their performance. You want people who are in charge of this fund to be experienced in their industry. You want them to have a real strong track record. You might even want to run a background check on them, because in this space, you're not going to get a whole lot of disclosures. They're not required to. It's a private placement, which is totally different than, again, the public markets that are scrutinized a lot by the SEC. So do your research here. Make sure you're not giving money to a crook. You definitely want to make sure that there's more than one or two people at the firm handling the fund. The more people that are involved in managing this private investment strategy, the less chance there is that it's going to be a fraud. You also want to have a lot of belief and confidence in the strategy that they're talking about as well. So, for example, there's a company I looked at here a few years ago that did the real estate thing, where they bought undeveloped land, they zoned it, they developed, and then they sold it to someone who was going to put houses on it. Well, they had done this in various zip codes around the country like 8 times. They've been doing it for a couple decades. And you could look at the track record of the performance of those funds. If you gave them money on day one, they collected money for like a 12-month period, and then they executed the strategy over the subsequent 5 years. And if you're comfortable locking your cash up for that 5-year period, they'd return 25% annualized over that period. That's pretty good. And this was like the 8th time that they had done that, which gave me a lot of confidence in the company, aside from the fact that there were like 150 people that worked there. A bad example here, I had a client a couple of years ago that came in and said that they bought into some private real estate development deal. And so I asked him about it and said, well, okay, what's the company that's managing it? Tell me more about the strategy. Who's responsible for it? What's their track record? What's their background? And the client said, well, it was only $10,000, so I didn't feel that bad about taking the risk. I don't know that much about the company, but the strategy seemed sound. They were going to go buy apartment complexes and then turn them around. And so that kind of made me raise an eyebrow. They had given this person 10 grand like 18 months prior, had never heard anything from them. They don't have a website. There is a legal document that my client was given when they signed on the dotted line and forked over the cash. Come to find out that this is just one person taking money from random people and then just putting it in an account. And kept saying, yeah, we're going to do something like that, something with that cash. I just haven't found the right deal. Well, I'm convinced that the guy was just spending it, and all of a sudden the $10,000 had vanished. It was just gone. And there was not a whole lot of recourse. You could pursue it legally, of course, but your legal costs are, easily going to approach the $10,000 that you put into it. So it just wound up being a total loss. So if you're getting into this kind of thing, don't give your cousin cash that's starting up this new crypto venture, right? Find someone with a little bit of a at least a little bit of a track record, with a robust team around them, and a strategy that is sound, that you can track. and just really dig into the details. Because if we think about all the Ponzi schemes, all the investment frauds that have happened over the years, the portion of all investment fraud in this country that has occurred in the private placement market, like I'm describing, as opposed to the public markets, is huge. The vast majority are going to be in private placements like this because they're not scrutinized as much by the SEC. Your massive ones, your Bernie Madoffs and so forth, those included everything. But there are a lot of just small scale frauds that happen. So make sure that you're buying into a reputable company. And there are a lot of managers out there that have huge companies, huge track records. Blackstone is a massive alternative investments manager with all sorts of checks and balances that, by and large, do a pretty good job. And so I'll leave it there. You get the point. Don't give money to your cousin who's going to start mining some new cryptocurrency. Make sure that there's a decent background there. Okay, that's it for today. Alternatives can really be great investments, but you have to be a good candidate for it first. And by and large, I think people jump the gun on this before they're ready. So make sure you check those boxes. Check out our financial order of operations episode from a couple of months ago if you're not sure whether you're there yet. And as always, if you need additional help, please do give us a call because that's what we do for a living. All right. Hope you guys enjoyed this. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.